20% of the world's oil flows through a channel 50 kilometers wide. 1/5 of global liquefied natural gas passes through the same narrow corridor every single day. The Strait of Hormuz sits between Iran and Oman, a maritime choke point so critical that its closure would send 20 million barrels of oil per day, searching for alternative routes that don't exist. This isn't speculation. This is the architecture of the global energy system right now. Markets already know something is wrong. Insurance premiums for tankers passing through Middle Eastern waterways have spiked. Freight rates are pricing in instability that hasn't fully materialized yet. When Iran and Israel exchanged missile strikes earlier this year, Brent crude jumped $5 per barrel overnight, not because supply was actually disrupted, but because traders understood how close we are to the edge. The price movement wasn't panic, it was recognition. But the Strait of Hormuz is just one pressure point. The Strait of Malacca handles 24 million barrels per day, serving as the primary artery for Middle Eastern crude flowing to China and Japan. 50% of China's crude imports move through that passage. China accounts for half the volume transiting the strait. When analysts talk about energy security, they're really talking about whether these narrow channels stay open and what happens when they don't. Bob Elmendeb connects the Red Sea to the Gulf of Aden. Houthi militants have been attacking ships there since late 2023. Major shipping companies responded by rerouting around the Cape of Good Hope, adding weeks to transit times and 40% to freight costs. That wasn't a hypothetical exercise. That was the global supply chain adapting in real time to a threat that persists today. Oil traffic through the Cape of Good Hope surged by nearly 50% in 2020, for as Saudi Arabia and Iraq diverted crude meant for Europe away from the Suez route entirely. Energy markets are already fragmenting. Flows that used to follow predictable patterns are being rerouted through longer, more expensive paths. Alternative pipelines exist, but they can't handle the volume. Saudi Arabia's East-West pipeline can move 5 million barrels per day from the Persian Gulf to the Red Sea, bypassing Hormuz entirely. The UAE has a pipeline with capacity for 1.8 million barrels daily. Iran built the Gorjask pipeline to create its own bypass. But these alternatives combined can't replace what moves through the strait on a normal day. The infrastructure was built as backup, not primary supply. The energy crisis forming now isn't about peak oil or running out of resources. It's about the declining capacity to maintain production from existing fields while investment in new projects falls dangerously short of what's required. Oil fields don't produce at constant rates. They decline. Every year, without new investment, global oil production would fall by 8%. That's 5.5 million barrels per day, disappearing annually just from natural decline rates at existing wells. In 2010, that number was only 4 million barrels. The gap is widening because the industry now depends more heavily on unconventional sources, like shale, which decline far faster than traditional reserves. Nearly 90% of upstream oil and gas investment goes toward offsetting decline, not expanding capacity. That means the entire global effort, all the drilling and capital deployment happening right now, is almost entirely focused on preventing production from falling. Very little is left over to grow supply. Investment in 2025 is projected at $570 billion. The International Energy Agency estimates $640 billion to $650 billion is needed by 2030 just to maintain stable output. That's a gap of $60 to $80 billion every single year, compounding. Bringing a new conventional oil field online takes nearly 20 years from exploration license to first production. 20 years. The decisions being deferred today will determine supply availability in 2045. Analysts warn that more than 45 million barrels per day from new conventional fields would be required by 2050 just to keep production flat at current levels. That's equivalent to adding the combined output of the world's 3 largest producers. And that assumes demand doesn't grow, which it will in developing economies. The underinvestment isn't accidental, it's structural. After crude prices collapsed in 2014, annual upstream investment fell from nearly $900 billion to around $580 billion today, adjusted for inflation. That's a 35% contraction that hasn't reversed despite prices recovering. Energy companies are returning cash to shareholders instead of drilling. Banks and institutional investors are reducing exposure to fossil fuels under environmental, social, and governance mandates. The capital required to sustain production is being redirected elsewhere while demand continues rising. Shale oil in the United States exemplifies the problem. Maintaining 6.1 million barrels per day of tight oil production requires drilling approximately 5,000 new wells annually at a cost of $30 to $35 billion. Without that continuous investment, production would decline 75% over a decade. Shale wells declined faster than any conventional resource if investment stopped immediately. Tight oil and shale gas production would drop by more than 35% within 12 months, then another 15% the following year. The system requires constant capital injection just to stand still. Most people don't realize how concentrated risk has become. Under natural decline rates, if investments ceased entirely, advanced economies would see oil production fall 65% over the next 10 years. Middle Eastern and Russian production would decline much more slowly because their fields are conventional giants with gentler decline curves. Energy supply would consolidate among a handful of countries with the lowest cost reserves, creating dependencies that didn't exist before. The United States, despite being the world's largest producer, relies on fast-declining unconventional sources. Europe has minimal domestic production. Asia imports nearly everything. The geographic imbalance intensifies every year that passes without adequate investment across the supply base. Cybersecurity threats compound the physical vulnerabilities. Energy infrastructure increasingly runs on internet-connected systems vulnerable to attack. In August 2024, Ransom Hub breached Halliburton, the world's second-largest oil service company involved in most global fracking operations. That same year, the Federal Bureau of Investigation warned that threat actors are targeting renewable energy infrastructure to disrupt operations, steal intellectual property, or ransom critical information. The North American Electric Reliability Corporation reported that geopolitical conflicts, including Russia's invasion of Ukraine and war in Gaza, have dramatically increased cyber threats to power grids. A successful attack on supervisory control and data acquisition systems at a major production facility could take output offline for weeks or months, triggering supply shocks that cascade through markets. Grid infrastructure isn't keeping pace with generation capacity either. For every dollar spent on renewable power generation, only 60 cents goes to ward grids and storage. Secure decarbonization requires investment in transmission and storage to grow even faster than clean generation, reaching parity at a 1-to-1 ratio. Right now, the ratio is tilted wrong. Many power systems remain vulnerable to extreme weather events, and digital security hasn't caught up to the expanding attack surface created by connected infrastructure. The transition to electricity-based systems creates new choke points, even as it aims to reduce dependence on hydrocarbons. Investment imbalances are particularly severe in emerging markets outside China. These countries represent 80% of global population growth and rising energy demand, yet they account for only 15% of global clean energy spending. Africa, with 20% of the world's population, receives just 2% of global clean energy investment. Total energy investment across Africa has fallen by 1/3 over the past decade, as fossil fuel spending declined without sufficient growth in renewables. Financing costs in emerging economies run at least twice as high as in advanced economies, creating a barrier that prevents capital from flowing where demand is growing fastest. The commodity supercycle that began in the early 2000s ended abruptly during the global financial crisis. When housing markets collapsed, demand for industrial metals, energy, and agricultural products fell sharply. Oil prices that had reached $147 per barrel in mid-2008 dropped below $40 by early 2009. The Bloomberg Commodity Index hit its lowest level since June 1999 in 2015. What many observers missed was the mechanism. Financial crashes don't just destroy demand, they also reveal how interconnected markets have become. Oil prices, equity markets, currency values, and commodity indices all moved together, amplifying volatility in ways that made hedging nearly impossible. Energy price shocks have historically triggered 2/3 of economic recessions since 1970. The pattern repeats. Oil prices spike due to supply disruptions or geopolitical events. Inflation accelerates, central banks tighten monetary policy, growth slows, and markets crash. The 1973 oil crisis led directly to stagflation. The 1980 shock precipitated a severe recession. The spike before the 2008 financial crisis contributed to the economic collapse. Analysts examining past crises find that when energy prices jump suddenly, stock markets react within days, and the effects persist for months. Recent research on the Russia-Ukraine war shows how modern energy crises transmit through financial markets differently than in the past. Natural gas and coal price shocks contributed more to energy price uncertainty than oil during that conflict. The sabotage of Nord Stream pipelines in September 2022 created peak uncertainty in energy markets. Yet stock market responses had already begun adapting months earlier when Russia first invaded. Markets learned to price in geopolitical energy risk faster, but that doesn't mean they've become more resilient. It means volatility is now built into asset prices continuously, rather than arriving as a shock. The current energy system operates on assumptions that are breaking down. Spare production capacity has fallen to historic lows. OPEC holds perhaps 2 to 3 million barrels per day of spare capacity. Non-OPEC producers have almost none due to systematic underinvestment. Emergency response capabilities are constrained by infrastructure bottlenecks. There's no margin for error. If multiple disruptions occur simultaneously, if a major choke point closes, if cyberattacks disable critical facilities, if declining fields collapse faster than expected, the system has very little buffer. And the buffer is shrinking. Every quarter, each year that investment remains below required levels, the gap compounds. Decline rates accelerate as the production mix shifts toward faster declining unconventional resources. Lead times for new projects stretch longer as experienced workforce retires and supply chains for specialized equipment atrophy. The services sector that supports drilling and production has contracted, limiting how quickly the industry can respond, even if capital suddenly becomes available. These aren't conditions that reverse overnight. They're structural constraints that take years to rebuild once degraded. Financial markets haven't fully priced the risk because the crisis hasn't materialized yet. Production remains adequate today. Prices fluctuate, but haven't spiked to crisis levels. The warnings come from engineers and analysts looking at decline curves and investment data, not from visible supply shortages, but this is precisely how systemic risks develop. They accumulate silently until a trigger event exposes the vulnerability all at once. The housing bubble in 2007 looked stable until it wasn't. The banking system in 2008 appeared solvent until Lehman Brothers collapsed and revealed the interconnected leverage underneath. Energy infrastructure today shows the same pattern: stability maintained through decreasing margins that eventually run out. The scenario is straightforward. Tensions escalate in the Persian Gulf beyond the skirmishes we've seen. Iran follows through on threats to close the Strait of Hormuz, either through military action or by mining the shipping lanes. 20 million barrels per day suddenly need alternative routes. Saudi Arabia's east-west pipeline redirects some volume to the Red Sea, but reaches maximum capacity almost immediately. The UAE pipeline adds another portion. Together they handle perhaps 7 million barrels daily at absolute peak. That leaves 13 million barrels searching for export routes that don't exist. Within 48 hours, global oil prices double. Within a week, they triple. Or consider a different trigger. A sophisticated cyberattack targets multiple production facilities simultaneously across different countries. The attackers aren't after ransom. They're nation-state actors looking to destabilize markets. Supervisory control and data acquisition systems go offline at refineries in Europe and Asia. Load management systems at North American power grids fail. Export terminals for liquefied natural gas in Qatar shut down as a precaution. The infrastructure isn't physically destroyed, but operators can't safely restart operations until systems are verified clean. That takes weeks, possibly months. During that time, 5 to 10% of global energy supply simply disappears from markets. Either scenario triggers the same cascade. Energy prices spike immediately because markets operate on expectations as much as physical supply. Traders don't wait for inventories to deplete. They bid up futures the moment they perceive shortage coming. That spike feeds through to every energy-intensive industry within days. Transportation costs jump first because fuel is direct input. Airlines ground flights or raise ticket prices by double-digit percentages overnight. Shipping rates surge as carriers pass through higher bunker fuel costs, affecting everything that moves by sea. which is most global trade. Manufacturing follows quickly because energy is embedded in production processes. Petrochemical plants that produce plastics and synthetic materials face input costs that double or triple. Steel mills and aluminum smelters, which consume enormous amounts of electricity, either curtail production or raise prices proportionally. These aren't marginal adjustments. When energy costs double, energy-intensive industries face existential choices about whether to keep operating. Some shut down temporarily. Others pass costs forward. Either way, the price increases begin propagating through supply chains. Food prices respond because modern agriculture depends entirely on energy. Fertilizer production requires natural gas. Farm equipment runs on diesel. Food processing uses electricity. Transportation from farm to market burns fuel. Cold storage demands continuous power. When energy prices spike, every stage of the food system experiences cost pressure simultaneously. Commodity markets for wheat, corn, and soybeans react within weeks. Grocery prices follow with a lag of months, but the increase is inevitable and substantial. The spike in food and energy costs from Russia's invasion of Ukraine provides recent precedent for how quickly this transmission occurs. Central banks face an impossible dilemma. Energy and food price inflation drives headline inflation rates sharply higher. Monetary authorities are mandated to control inflation, typically through interest rate increases. But raising rates while economies are experiencing supply-driven cost shocks makes recessions worse without addressing the underlying problem. Higher rates can't produce more oil or grow more food. They can only destroy demand by making credit expensive and slowing economic activity. Central banks in developed economies learned this during the 1970s. They're about to relearn it. If major central banks raise rates in response to energy-driven inflation, borrowing costs spike across entire economies. Mortgages become more expensive. Corporate debt that needs refinancing faces higher interest payments. Governments with large debt burdens see servicing costs rise. Equity markets reprice downward because the discount rate for future earnings increases. Bond markets sell off as yields rise. Credit spreads widen as lenders demand more compensation for risk. Financial conditions tighten across the board. Equity markets typically fall 25 to 35% peak to trough during recessions. Based on historical analysis, industrial metals drop by similar magnitudes as economic activity slows. Copper, zinc, aluminum, and nickel all decline sharply when manufacturing contracts. But the current situation creates cross-currents that make simple historical patterns unreliable. If the trigger is energy supply, disruption, energy stocks, and commodity producers initially benefit from higher prices, even as the broader market falls. That creates sector rotation. Unlike typical recessions where everything declines together, precious metals behave differently. Gold tends to appreciate during financial crises and periods of high uncertainty. When investors lose confidence in paper assets, they rotate toward physical stores of value. Historical analysis shows gold prices typically rise 5% or more in the 12 months following recession end compared to 12 months prior. If the energy crisis triggers currency concerns or inflation fears that persist, gold could appreciate significantly more. Silver and platinum also act as safe havens, though with greater volatility than gold. Currency markets face their own disruptions. The US dollar typically strengthens during global crises as investors seek safety in the world's reserve currency. But if the crisis originates from energy supply disruptions that hit the United States as hard as other regions, that safe haven bid might not materialize. Currencies of energy exporting nations could strengthen relative to importers, creating unusual exchange rate patterns. Japan, which imports virtually all its energy, would see the yen weaken substantially. European currencies would face similar pressure given the continent's dependence on energy imports. These currency moves amplify trade imbalances and create additional inflationary pressure for importing nations. Emerging markets face disproportionate impact. Countries that import energy and have dollar-denominated debt get hit from multiple directions simultaneously. Higher oil prices increase import costs. Stronger dollar makes debt servicing more expensive. Capital flight, as investors seek safety in developed markets, dries up financing. Interest rates rise globally as central banks tighten, making new borrowing prohibitively expensive. The combination has triggered emerging market crises repeatedly in past decades. It would likely do so again. Developing economies in Africa and South Asia that already struggle with energy access face catastrophic effects. Many of these countries spend significant portions of foreign exchange reserves on energy imports. When prices double, those reserves deplete rapidly. Governments face choices between importing fuel or importing food. Social stability deteriorates quickly when populations can't access either. History shows that energy price shocks in vulnerable countries lead to political upheaval, mass protests, and sometimes regime change. The Arab Spring that began in late 2010 had many causes, but food and fuel inflation played significant roles. The interconnection between energy prices and financial markets means disruptions don't stay confined to energy sector. A sustained spike in oil prices affects corporate earnings across every industry. Airlines report losses and cut capacity. Automakers see demand for vehicles fall. Retailers face both higher costs and reduced consumer spending. Earnings expectations that underpin stock valuations prove too optimistic. Analysts downgrade forecasts, markets reprice accordingly. What begins as energy shock becomes broader economic contraction. Credit markets seize up when uncertainty spikes. If banks can't assess counterparty risk accurately, they stop lending to each other. Interbank lending rates rise sharply. Commercial paper markets freeze as companies can't roll over short-term debt. The mechanisms that enable businesses to meet payroll and fund operations through short-term borrowing break down. This is what happened in September 2008, after Lehman Brothers collapsed. The trigger was subprime mortgages, but the transmission mechanism was credit market paralysis. An energy crisis could trigger the same dynamic through different channels. High-frequency trading algorithms that dominate modern markets can amplify volatility dramatically. When prices begin moving rapidly, algorithmic trading systems execute preset risk management protocols. That often means selling positions to reduce exposure. When many algorithms do this simultaneously, selling pressure intensifies beyond what fundamental factors justify. Flash crashes become more frequent. Circuit breakers that pause trading get triggered repeatedly. The infrastructure designed to prevent panic can itself create panic when traders realize they might not be able to exit positions. Leverage throughout the financial system remains elevated despite reforms after 2008. Hedge funds operate with significant borrowed capital. Private equity firms used cheap debt to finance acquisitions. Corporate balance sheets carry record debt levels after years of low interest rates. When asset prices fall and volatility spikes, leveraged positions face margin calls. Entities need to post additional collateral or liquidate holdings. Forced selling creates downward pressure, disconnected from fundamental value. The spiral feeds on itself. Commodity futures markets operate on margin systems that require participants to post collateral against their positions. When prices move dramatically, margin requirements increase. That forces participants to either post more cash or close positions. During extreme volatility, some participants can't meet margin calls and default. When defaults occur in interconnected markets, the effects cascade. We saw this during the nickel market crisis in March 2022, when prices spiked 300% in 2 days. The London Metal Exchange had to suspend trading and cancel trades, breaking the market's fundamental function. Real economy effects lag financial market disruptions by months, but eventually manifest. If energy prices remain elevated, industries that can't pass costs forward begin failing. Airlines with thin margins file bankruptcy. Shipping companies default on debt. Manufacturing plants close permanently rather than temporarily. Each closure eliminates jobs and reduces productive capacity. Unemployment rises, consumer spending falls, housing markets weaken, and the feedback loop strengthens. Governments respond with various interventions, but policy options are limited when crisis stems from supply shortage rather than demand collapse. Strategic petroleum reserves can be released to provide temporary relief, but those reserves are finite and designed for short-term emergencies. The United States Strategic Reserve holds about 370 million barrels. That sounds like a lot until you realize global consumption is roughly 100 million barrels per day. The entire U.S. reserve represents less than 4 days of global demand. Other countries have smaller reserves. Using them provides a buffer measured in weeks, not months. Fiscal stimulus becomes politically popular but economically complicated. Governments may want to subsidize energy costs or provide direct payments to households. But if the underlying problem is insufficient supply, subsidies just shift who bears the cost without creating more energy. They can even worsen shortages by maintaining demand at artificially high levels. Price controls create black markets and exacerbate distribution problems. The policy tools that work for demand-driven recessions don't work the same way for supply shocks. International cooperation becomes critical, but difficult to achieve when countries face domestic political pressure. Energy exporting nations have incentive to maintain high prices. Importing nations want prices lower. Competition for available supply intensifies. Countries that have secured long-term contracts or alternative suppliers benefit at the expense of those dependent on spot markets. Alliances based on shared energy vulnerability might form, but coordination takes time, while crisis demands immediate response. The scenario doesn't require everything going wrong simultaneously. It requires only that the margin of safety that currently exists disappears. Right now, the system has perhaps 2 to 3 million barrels per day of spare capacity globally. That's less than 3% of total demand. A single major disruption could exceed that buffer. Multiple smaller disruptions happening in close sequence would have the same effect. The probability of at least one significant disruption occurring over the next several years is high given geopolitical tensions, infrastructure vulnerabilities, and accelerating decline rates at existing fields. Markets currently price energy risk as manageable because major disruptions haven't occurred recently. The last true oil shock was in the early 2000s. An entire generation of traders, analysts, and corporate decision-makers has no direct experience with sustained energy crisis. Risk models calibrated on the past 2 decades may dramatically underestimate tail risk. Nassim Taleb's concept of black swans applies directly here. Low-probability events with extreme consequences that models trained on normal periods fail to capture. When the crisis begins, whether through geopolitical conflict, cyberattack, faster than expected decline rates, or some combination, recognition will be sudden. Markets that seemed stable will reprice violently. Assets that appeared uncorrelated will move together. Diversification strategies will fail because systemic shocks affect everything. Investors will discover that many risks they thought they hedged were actually the same risk viewed from different angles. This is how financial panic manifests, not as gradual deterioration, but as abrupt recognition that assumptions underlying all valuations were wrong. The hidden energy crisis is hidden only in the sense that it hasn't disrupted supply yet. The vulnerabilities are documented. Energy agencies publish the analysis. Industry executives issue warnings. The data on underinvestment, declining spare capacity, choke point risks, and infrastructure fragility is available to anyone willing to examine it. What remains hidden is the market's collective unwillingness to price the risk until it becomes reality. By then, hedging becomes impossible and losses become inevitable. This is how overnight collapses happen. Not because no one could have seen them coming, but because market participants chose not to look.